Okay, I'll give a brief background to the paper that's been circulated, to just sort of put it in a bit of context, and then I'll go through my slides. Since last September, I've been acting as a so-called expert advisor to the European Parliament's Monetary and Economic Affairs Committee. The committee meets with Jean-Claude Trichet 4 times a year in what is essentially the only public accountability measure enforced upon the ECB. ECB is very independent, not terribly accountable, but 4 times a year the president has to go to this committee and answer questions. And so 4 times a year they contact these team of experts and give them some issues that they want them to discuss. And I was asked in particular to discuss a set of issues to do with ongoing developments in relation to the sovereign debt crisis. The paper focuses at the end quite a bit on issues to do with the ECB's bond purchase program. I'll talk less about that here. The reason there's so much of that in the paper is that ultimately the point of the paper is a briefing paper to prepare the MEPs for their meetings with Trichet. In preparing the paper, I decided to kind of wander a bit off topic, since the topic was more the third item here, the ECB sovereign bond program, but I felt it was important to give the MEPs a sort of broader perspective on what was happening, or give my 2 cents on what was happening. And what's happening broadly has been termed something called the euro crisis. You know from reading the newspaper that somehow, in some way, the euro is somehow in crisis. And as a response to that crisis, there's been something called the Eurozone Stabilization Fund, which is a major initiative announced on May 9th. So what I'm going to do is just kind of go through and talk about the euro crisis. What is it and what it isn't. Then talk about the Eurozone Stabilization Fund, talk about what I see as the rationale for it, and then briefly discuss the ECB's role in all of this, which up to now has been its sovereign bond program. Okay, I'll try and do this in 20-25 minutes. So that's the first thing that you could say about the euro crisis, is that it's got something to do with debt. It's somehow a debt crisis of some form or another. It's worth taking a step back, though, from looking at Greece or Ireland to understand that the euro area itself is not really having a debt crisis. It's pretty well-known statistics, but it's worth keeping them in mind. If we think about deficits, the European Commission projects this year that the euro area is going to have a deficit of about 6.5% of GDP. Now, in comparison, the UK is going to have a deficit of 12%, the US is going to have a deficit of 10%. So it's certainly not having a deficit crisis, or if it's having a deficit crisis, then these 2 countries are having far bigger deficit crises. What about debt levels? Debt levels, the euro area's debt levels are basically right in between the UK and US debt levels. So overall, the euro area itself is not having a debt crisis, and it's in fact better positioned than the UK and the US. I mean, nobody's saying 6.5% of GDP is a great place to be starting from, but there's undoubtedly a lot of economic slack in the euro area, and one could hope that this could be made up without, on average, draconian cuts. Of course, some specific countries clearly are having debt crises, and there's a combination here of sort of 3 things. There's a combination of large deficits, varying across countries, or moderate enough deficits, maybe not that big, but coming on top of very large debt ratios to start with. And the final element here that's sort of kind of missing from this is the concern that in various countries the debt ratios are kind of understating the potential for sovereign risk because of problems to do with the banking system and potential liabilities that come from the banking system. I think that's an element here in terms of the Irish scenario, that even if one projects forward what the Commission expects the debt to GDP ratio to be, you kind of have to put an asterisk on that and think about various banking-related losses. Okay, the sense in which this is a euro crisis is that these countries don't have the option of devaluing. Around the world, you tend to see fiscal crises lead to devaluations for fairly obvious reasons. Fiscal adjustment has a negative effect on the domestic part of the economy, and devaluation will improve the competitiveness of your export sector, and that will help sort of boost the negative effects of fiscal adjustment. Furthermore, there's the additional effect of that devaluations lead to higher import prices. That raises inflation, and overall that tends to reduce the value of the debt relative to nominal tax revenue. So it's an element of sort of inflating your debt away. Now, you don't want to overstate how important these effects are. It's regularly discussed these days as a panacea, you know, that if you do, you can devalue and all these wonderful things will happen. I mean, the more open you are, the more import price inflation you're importing, and the faster it will get into wages, and ultimately the positive effects in terms of improved competitiveness will be temporary. Nevertheless, it is something that can help you when you're in a fiscal crisis, at least for a period of time. And countries like Greece, Spain, Portugal, and Ireland, you know, could really do with a bit of help on this front in terms of competitiveness. Now, you might look at the ECB and say, well, given the debt crisis, perhaps the ECB will help out here. The ECB will generate a bit of inflation, or the ECB will contribute to a sort of euro-wide devaluation. Now, we have seen the euro decline, but by and large, the ECB is not inclined to play ball in terms of generating more inflation to assist with fiscal crisis. And we can see that for two reasons. One, the euro area itself is not having a fiscal crisis. And secondly, the ECB is extremely focused on price stability. President Trichet likes to say, we are inflexibly attached to price stability, which sounds bad to me, but he reckons it's a good thing. Okay, so we can see why the countries that are having severe sovereign debt problems, why they would like to be able to devalue, and we know they can't because they're in the euro. Does that on its own make this, you know, an existential crisis for the euro? I've been surprised by the extent to which media commentators have taken the flying leap from it might be nice for countries to devalue to, you know, they're going to look to do so and it's going to be the end of the euro. I think a sort of sober answer to this is that this is not an existential crisis for the euro, for now at least. It will be my judgment, and I think that of the vast majority of professional economists, that take the most extreme case, Greece, that I think Greece is unlikely to leave the euro in the next coming years, even under conditions where it has a sovereign default of some sort or another. The thinking of a lot of economists on this is very influenced by the debate that was had around a number of years before the onset of the crisis, with papers by Barry Eichengreen being particularly influential, where they discussed the idea that the euro is not simply a set of fixed currencies against each other. You know, it's not simply that, you know, we have somewhere in the background we have the punt and we've just fixed at a certain rate. The euro is a common currency throughout the economic area, and there are very serious legal and technical difficulties in going and establishing your own currency with the purpose of devaluing it. For a start off, I mean, imagine how this is going to happen, right? You're in Greece, and one day we say 1 euro in Greece now equals 1 drachma, and then tomorrow 1 drachma doesn't equal 1 euro anymore, it equals half a euro. You can't do this overnight. And once people know that you're planning to do it, then they don't want their money in Greek bank accounts that are about to be converted into drachma. If you're in the European Union, there's free movement of money in the European Union, and so you can just take your money out. You can try to impose capital controls. If you impose capital controls, you're breaking the European Union's laws in relation to free capital movements. Furthermore, there are legal issues to do with the fact that the euro is intended to be the common currency. All countries, including the UK, have, at least in theory, signed up to the idea of joining the euro at some point. If you join the euro and then you leave, there are some legal arguments that say that you have to leave the European Union as well. So, while one can sort of do a sort of ceteris paribus argument for why devaluation may be a good idea, I think it's very unlikely that at a time of crisis that a government, such as the Greek government, would choose at the same time to risk a banking crisis, all the reputational issues that go with uncertainty about European Union membership. And remember afterwards, if you're going to lend to Greece, it's not that you're going to have to factor in potential devaluation, and basically you wouldn't lend to them in their new currency. So it would not lower borrowing rates. So there's various legal issues about whether or not the euro-denominated debt that you borrowed is still in euros or still in drachma. There's a lot of complex issues to do with sovereign default issues in those cases. So I think that's the bottom line now. I don't think Greece is going to leave the euro. I don't think Ireland's going to leave the euro. But you know what? Even if they did, even if Greece left the euro, so what? Greece are a great example because the euro survived. You know, the euro existed for 2 years before Greece joined. Maybe we should have never let them in. But you know, one can imagine a European monetary union without Greece because it's happened before. I don't think that that's the type of thing. I think a peripheral country dropping out of the euro and establishing their own currency, I don't think that's the threat to the euro, to the extent that one can imagine an existential threat. I think one can, but I don't think that's the threat. I think one of the things that's confused people, particularly various kind of people who aren't particularly au fait with the various issues to do with currency movements, is the decline in the value of the euro has, to a lot of people, been taken as a signal that there's something desperately wrong with the euro. You know, the euro used to be worth, $1.50 and now it's $1.20 and whatever, it moves around all the time. There basically is no particular reason to be concerned about the value of the euro. There's a few issues. You think about sort of the kind of models that economists think about when they think about currency valuations. By and large, they think about sort of portfolio balance type issues, which is, how attractive are the assets denominated in a particular currency? If they look attractive, you need to get into that currency to buy those assets. There's quite a few things that have happened over the last year that have made people sort of reconsider how attractive European assets are. Various asset classes, like sovereign debt, that people considered essentially risk-free, are now not considered risk-free. There's worries about European banks. Maybe you don't want to buy European bank bonds. And there's various worries about growth given fiscal retrenchment, which makes investing in equities and all sorts of other things less attractive. Put them all together, very little surprise that the euro has declined. But the euro decline is not in any sense related to this sort of existential crisis. And the euro being at 127 today, was at 127 3 or 4 years ago, was at 127 a couple of years before that, and nobody thought there was anything particularly strange, good, bad, or indifferent about that. And of course, ultimately, euro devaluation is good news, particularly for countries like Ireland that are facing serious sovereign debt problems. And we could really emphasize this for the euro as a whole. The unemployment rate for the euro as a whole, for the euro area as a whole right now is over 10%. It's 3 percentage points higher than it was at the start of the crisis. Inflation is well below the ECB's target and unlikely to get above it. So devaluation of the euro falling in value is a good thing. Okay, so that's the sort of background of thinking about the euro. 2 reasons, by and large, have been cited for the May 9th decision, which is an extraordinary historical decision, to introduce a sort of contingency bailout fund of a combined $750 billion between EU and IMF funds. One is financial stability inside the euro area. In fact, the fund is called something like a European financial stability sort of fund. You actually tend not to hear that much about that, however, from politicians, particularly when the thing was announced. Instead, you tend to hear about this thing, saving the euro. If one looks at the politicians' comments after the fund was announced, you had Sarkozy saying, we need to save the euro. It's a project that's been we've been building up for this for generations, and we can't let speculators prevent this. The Commission's economics commissioner, Mr. Rain, said we will do everything necessary to protect the euro. Angela Merkel went to the German parliament and said this is about saving Europe. Perhaps this is a cynical interpretation, but I really think that this has been overhyped. And you can see that from what I said before. I think the first first issue here, the financial stability rationale, is a serious one. I think that's really what underlines the program. The problem is, the more you look at it, the more you think about it, the more you realize it's a sort of a political hot potato. So you maybe don't want to talk about it too much. Think about the financial stability concerns. Focus on Greece for a second. The Bank of International Settlements estimates that Greece has 193 billion in debt that is held by European banks. 78 of it, funnily enough, is held by French banks. This puts Mr. Sarkozy's enthusiasm for the financial stability mechanism in some context, right? And why he might want a big fund, right? Because if Greece is let default and you lose some large fraction of this money, suppose you lose half of this, that's 40 billion that by and large you can be sure these particular French banks cannot do with losing. Hence, they're going to have to go cap in hand to the French government for grown yet another bank bailout. Okay? That's the last thing that anybody in the world, anyone in Europe wants, is more money getting put into banks. It may be inevitable, it's going to happen anyway. And we can see it's not just Greece. We can see the exposure to Portuguese banks, or Portuguese debt, and the exposure to Spanish debt is enormous. The Italian debt figures are even bigger. The 750 billion figure for the fund looks, the phrase that was used was it was shock and awe and so on, in the sense that it was being compared with sort of the Powell doctrine of overwhelming force. In fact, if you look at the size of the exposure of European banks to debt of troubled countries, it's not clear that it's oversized. In fact, it looks about right that it may be needed. I think that's the real rationale. And one of the sort of starting points for thinking about this is that the sovereign debt problems, they're very strong echoes. You can see them already of the problems with subprime mortgage-backed securities going back 3 years ago, 2 years ago. Markets aren't very sure about what the exposure of individual banks are to the various types of sovereign debt. Banks tend to be a little tight-lipped in their reports about exactly what type of securities they're holding, particularly if they're bad securities. So, most banks have in their notes somewhere that they have sovereign debt of a certain amount. It's rarely broken out into, is it Greek, is it Portuguese, and so on. And of course, the bank capital regulations have normally treated any kind of OECD sovereign debt as being absolutely clean, so that it gets a very low risk weighting. So the idea that something that you're holding that's supposed to be really low risk could turn out to be you get 50 cents on the dollar for it has very serious implications for their capitalization relative to risk-weighted assets. We don't know who's holding this stuff and who isn't. And you can see what this has done in terms of interbank markets have tightened up, and bond issuance has been, by banks, European banks, has been pretty minimal over the past couple of months. I mean, certainly at the time I wrote the paper, I would have said there was none. Through May, through most of June, there is some over the past week or so, but generally only for sort of what are seen as the better risks. So the Stabilization Fund can be viewed as an attempt to do something that couldn't be done with the mortgage-backed securities, which is to sort of cut it off at the pass. Right? And the mortgage-backed securities wasn't going to be feasible for the US government to go out to every, member of the public that had taken out a dodgy subprime mortgage and was in trouble and go and help them all out. simply not really a feasible option. Too many of them, and perhaps too much money required. And various fairness considerations. Why do they get a bailout? Why do other people not get a bailout? What can be done is you can put together a fund that says we're going to help Greece, we're going to help Portugal, we're going to help Spain, and either eliminate these sovereign defaults and so they just aren't going to happen, or else at least manage them. I think in the Greek situation it's now pretty widely accepted that probably the best that could be hoped for is some class of managed sovereign default. So I mean that's sort of the rationale. The problem with this as a rationale is, if the EU Commissioner or President Sarkozy has to get in front of the microphone on May 9th and say, we're saving French banks, we're saving German banks, this is great, you should be thrilled. That's not going to go down that well with the public. We are saving our, Greek brethren, we're saving our Portuguese brothers. Sounds a little bit better, but still doesn't, have a lot of appeal in certain parts of Central Europe. However, we are saving the euro, the grand project of the euro, and all it means. That sounds good. That has, you can market test that, and it would do okay. So I think that's ultimately what we've seen. Now, the paper goes in some detail into a discussion of how, well, probably the euro itself is at no great risk over the next couple of years at all. But these kinds of developments, the introduction of a stabilization fund and its consequences, could go either way in terms of saving the euro. So I'm trying to play devil's advocate here a little bit. For a lot of people say, this is going to help shore up the euro and help keep all these countries in the euro because, it's to some extent an element of fiscal coordination, which one might think might be necessary inside a monetary union. Also, if a country like Greece, Portugal, Spain goes bust, there's a sovereign default and there are nasty consequences for it, having the Stabilization Fund, which I can assure you has a lot more money than the IMF on its own would have had. Right? One of the discussions that's come up every so often is, well, why do we need the fund? Why can't we just have the IMF? IMF doesn't have the money to bail out. And there's an issue here for Ireland. The IMF has the money to bail out Ireland. The IMF would have had the money to bail out Ireland and Greece. The IMF does not have the money to bail out Greece, Ireland, Spain, Portugal, and so on. They just don't have the money. They're the positive side of it. The positive side of it is that you imagine a scenario in which Ireland is about to go into a sovereign default, and rather than people say, well, it was that damn euro that did it, we should really leave that thing, people say, it was being in the euro allowed us to tap this fund that has helped us so much to not have a crisis. Okay, that's one potential scenario. I think the truth of it is, I'm more inclined to go the other way and say that the probability of a long-term breakup of the euro has probably increased as a result of the reaction to the sovereign debt crisis. Both in terms of smaller countries potentially leaving the euro and in terms of what the really greater risk is, which is a large central country, particularly Germany, potentially thinking about leaving the euro. Take the positive side of, well, now you've got the EU's Stabilization Fund, and that's going to help you through the crisis. In practice, you could rephrase that as people should love the IMF, right? The IMF come into countries all around the world and stop them from having to go immediately from a 10% deficit to zero. They give them money and they help them with an adjustment program and so on. In practice, the IMF are despised. Right? It's a little like the old tale of about the Russian doctors that used to turn up everywhere the smallpox was, and then people started thinking that the doctors caused the smallpox. But it's real all the same. The EU and Euro membership are likely to get blamed in countries when they come in and say, well, your budget deficit is too big, we're going to help you out temporarily, but you need to do A, B, C, and D. And it's very convenient as well for finance ministers One can imagine a future scenario in which Brian Lenihan says, you know, I didn't want to cut child benefit again, but, you know, those people from Brussels made me do it. Beyond that, you can't have a fund like this in existence without some quid pro quo. And the quid pro quo clearly has to be greater EU monitoring. If your money's on the line, you cannot afford to have a Greek situation develop again in which the books are fiddled or in which monetary or fiscal policy is set on a completely unsustainable path. So we can see that this is happening already. We're going to have this wider amount of EU monitoring. I think for most people that's a good thing, particularly if you've lived in a country that has repeatedly messed up its own fiscal policy formulation. However, there are lots of countries where there are anti-Euro, anti-European sentiments, you know, bubbling under various parties that would like to see their country pull out of the Euro or pull out of the EU. And this is going to help fuel these kinds of things. You know, when you get to the moments where a particular government wants to run a larger deficit and Brussels are intervening and saying, well, actually, no, we've went through the process now and you need to raise taxes or cut spending. That's the kind of thing that is going to, I mean, we even saw, to some extent we saw it here. Fine Gael's reaction to these proposals was to talk about undermining of national sovereignty and so on. And Fine Gael are not what I have in mind when I think of a anti-European party. So that's in the countries being helped. They're not necessarily going to react positively to this helping hand. But probably more serious is institutionalizing these setups raises the prospect of repeated bailouts. And we know what direction the bailouts are going to go from. Right? The bailouts are not going to be Greece, Portugal, and Ireland giving a hand to Germany to bail itself out. The bailouts are going to go in one direction. And, you know, the current bailouts were unpopular enough. Institutionalizing it and setting up a framework in which this can happen again, ultimately this kind of thing may be a bigger long-run threat to the euro. The real threat to the euro is that someday some German political party sees that the public are fed up with the euro and uses that as a campaign vehicle and decides to leave. I don't think this is a likely scenario. But, you know, there's some probability on every scenario, and I think the probability in this scenario is a good deal higher today than it was a year ago, and it's a good deal higher today than it was a few months ago. There are serious practical issues with this as well. German banks have assets and liabilities like every bank. Their liabilities are by and large deposits of German citizens. Their assets, they have a lot of assets that are stuff that is investments and loans outside of Germany. As soon as you have the Germans leave the euro to redenominate everything in Deutschmarks, chances are the Deutschmark will appreciate, so their liabilities will appreciate. Lots of their assets that are not going to be in Deutschmarks, that are still going to be in the old euro, are going to depreciate. Very likely, Germany leaving the euro would lead to a banking crisis. Different kind of banking crisis that happens when Greece decides to leave the euro, which is a sort of a liquidity crisis and people run for the hills. But it's a banking crisis all the same. So I think by and large, there isn't a long-term threat to the euro. The threat to the euro is of a different nature than is largely being discussed. And with ECB, the recent period has not been kind to the ECB. ECB has always styled itself as highly independent politically, and we've seen two major decisions that have undermined that image that it has of itself. The first was the decision to allow Greek debt to count as eligible collateral for its loan operations, no matter what ratings that they have. ECB has traditionally said, well, we'll accept any sort of collateral and may give you a loan based on that collateral, as long as it's rated highly enough by the ratings agencies. However, knowing that Greek debt is continually getting downgraded, they've come out and said this. And this has happened despite President Trichet saying that there'll be no special treatment for any country. And it was clear what he meant by that, and has gone back on this. The second is the second undermining their credibility has been their decision to buy government bonds on the secondary market. Now, this clearly breaks the spirit, if not the letter, of the no monetary financing clause. On its own, I don't have a great problem with that, but one needs to understand that political independence of the ECB has always been something that it's prized, and these two decisions have clearly undermined it because they've come from partly from political pressure. They raise various issues as well in terms of these ratings and so on. If you hear about what the ECB's justifications are, for instance, Lorenzo Bini-Schmagi, who is a member of the ECB executive board, says, well, the ratings agencies suck anyway, right? We all know that now. So, we think we have a better handle on Greek debt and what it's worth than the ratings agencies. And we've seen this again with the government bonds. They've talked about, we felt we had to intervene because the rates on government bonds were just so far away from what we thought was sensible, and the markets weren't functioning properly. Effectively, what's happened here is that the ECB has decided to substitute its judgment for what sovereign risk is and how sovereign debt should be priced for the markets. And, even if they're right in this instance, and I don't necessarily think they are, that's a precedent that once said is a sort of dangerous precedent. In this case, the buying of bonds on secondary market, or the treatment of the Greek debt as eligible collateral, I mean, who's to say every government in Europe or inside the euro can't now say, us too, buddy, we want you to treat our debt this way, or we'd like you to buy some of ours because we're in trouble. Okay? Once you've done it for one country, it can be hard not to do for others, and then the ECB ends up being a sort of arbiter of all sorts of fiscal issues that ultimately, before this, markets were deciding. The ECB's program lacks any kind of transparency. I talk about this in the paper. Maybe it's all a moot point now because the program seems to be tailing off, but it's extraordinary what we don't know about the program compared to similar programs that were undertaken by the Federal Reserve or the Bank of England. We don't know what they bought, although we hear time and again that about 70% of it was Greek debt. We don't know the criteria being used to select the bonds to purchase, although if it's mainly Greek debt, it's clear that the program was not particularly about keeping primary bond markets open. Right? One thing the market could have done is the market could have been focused on, okay, well, Greece are gone, forget them, and they've got their bailout. But, the Irish could do with a bit of help, and so every week that they have a primary bond auction, we're going to kind of make it clear that we're in the market and we're going to buy a bunch of Irish debt. And that could have been a rationale for the program. That does not seem to have been the rationale. However, going back to financial stability concerns, lots and lots of banks own Greek debt, okay, and would like to get it off their books and have gotten a lot of it off their books to the ECB, who now are holding this stuff, and the ECB are likely to take a hit on it if it's downgraded. Which raises a lot of issues to do with what happens then to the ECB. Losses on securities owned by the ECB, in theory, are spread amongst all the participating countries. We don't know whether they were doing this in terms of the primary issuance, weeks of primary issuance, so we don't know how long the program is going to last. However, it looks like the program's tailing off. There were 16 billion purchased in the first week, and then there was a bunch of slightly smaller numbers. Now, last week, we know they only purchased about 1 billion. It's actually 0.8 of a billion. So the program might be finished, or it might just be finished for now. On its own, I mean, the ECB, the power to print money is a very valuable one. On its own, the ECB could play a major role if the sovereign debt crisis flares up again. Wholesale intervention by the ECB to purchase SEC bonds in the secondary market could have a major impact in averting the sovereign debt crisis and in preventing countries from having to go to the Stabilization Fund. I don't know if that's going to happen, if there's a sort of next phase of the crisis, but right now my bet would be it's not going to happen. That the ECB had already in a way been pushed too far and was not happy with the undermining of its independence that occurred during the first half of this year. We know that Axel Weber, the Bundesbank president, was not in favor of the bond purchase program. We know that Jürgen Stark, a member of the executive board, was not in favor. And my guess is it's looking more and more like the ECB purchase program was a concession to the EU Council to have something in place as a sort of temporary stopgap while the stabilisation mechanism funds were being put in place. It's probably no coincidence that as the ECB's bond interventions have sort of tailed off, you've also seen the borrowing situation worsening for various countries that are potential participants in the bailout fund. Slowly but surely, it hasn't gotten that much attention, but Irish bond spreads over German bonds are now at 276 basis points, and that's not too far off what they were, the day before the fund was announced. Portuguese spreads are up to 303 basis points. And there's also increasing worries, I think, out there that various bank funding problems, associated with sort of interbank tensions I talked about before, are going to spread over to sovereigns. And that's, not to put too fine a point on it, a major issue for Ireland. So it seems to me that the likelihood of the EU IMF fund being called on is increasing, and that we may see this thing in operation later this year. Okay, that's a bit longer than I had meant to talk, but
thank you very much.
Okay.
Very interesting.